Hi CS students, let's revise CA Final AFM Advanced Capital Budgeting Decisions Chapter 3 Illustration 2. So let's go through the question once. XYZ Limited requires 8 lakh for a project and useful life is 4 years. Salvage value is null. Depreciation charge they have given us 2 lakh per annum, which is ideally 8 lakh minus salvage value, which is 0 divided by 4. So 2 lakh they have already given in the question. And expected revenue and cost they have given ignoring inflation, means it is not adjusted by inflation. And revenue and cost they have given, and tax rate as 60% they have given. Cost of capital is 10%, which is already inclusive of premium. So in the previous question, as we can see, it's the same type, but they've given annual cash flow, but here they have given revenue, cost. So first we have to find out the annual cash flow, then that will be a real cash flow. So we have to find inflation adjusted nominal cash flow, then only we can discount it with the cost of capital of 10%, which is inflation adjusted. For calculating cash flows, which is inflation adjusted, so they've given revenue inflation rates and cost inflation rates, which is year wise. So first we have to find out inflated adjusted revenues, and then inflation adjusted cost, then tax benefit on depreciation to arrive at the final nominal cash flow. So we'll go through one by one. First, revenue they've given for year 1 6 lakh, then year 2 7 lakh, then year 3 8 lakh, then year 4 8 lakh. So year 1 6 lakh revenue, wherein they've given 10% as the inflation rate. So 6 lakh into 6 lakhs plus 10%, which will come up to 6 lakh 60,000. Then 7 lakh for second year. So 7 lakh we are projecting today, saying that after 2 years I'll receive a revenue of 7 lakh. So I know that for the first year the inflation rate is 10%, and for the second year it will be 9%. So the 7 lakh is as on today. So first I have to adjust for year 1, then year 2, right? So 7 lakh into first year inflation rate 10%, then second year inflation rate 9%, I'll get 8,39,300, which signifies that as on today I am projecting I will earn a revenue of 7 lakh in the second year. After inflation adjustment, it will go up to 8,39,300. Same way, third year revenue I am projecting as 8 lakh. So first year, second year, and then third year inflation rates I'll adjust, and that would come up to 10,35,000. Same way for fourth year also, based on the inflation rates given in the table, we'll arrive at a value of 11,08,452. Now we have inflation adjusted revenues for all the 4 years. Now the next step of finding out a cash flow. So I'll give the flow for the annual cash flow. First we'll take the revenue minus our cost, then we'll arrive at a profit which is before tax. So we'll adjust in that depreciation also will be involved. So there are two ways of doing this. We'll go on the approach given in the ICAI only. So the simple thing is, there is a tax benefit involved on depreciation. Why? Because depreciation is an expense, allowable expense in income tax, and it will reduce our profits. Because of that, our tax will get reduced. So the same way, my revenue minus cost, which is my cash flow, net cash flow, on that I have to add this revenue minus cost, I will reduce the tax portion, which I will get a cash flow. Then The tax benefit on depreciation that I will add, that is my nominal cash flow inflation adjusted, right? So first we have calculated this inflation adjusted revenues, then inflation adjusted cost also, the same way as revenues how we did. So 3 lakh into 12%, like 3 lakh plus 12%, 3 lakh 36,000. Then 4 lakh into first year inflation, then second year inflation 4 lakh 90 to 800. Then third year cost is 4 lakh. First year inflation 12%, second year 10, third year 9%, 5 lakh 37 152. Then fourth year cost. So now we have inflation adjusted now we have inflation adjusted revenues for 4 years and inflation adjusted cost for 4 years. The tax benefit on depreciation is simple, 2 lakh into whatever tax rate. That much only I will save, right? So 2 lakh into 60% they have given us tax rate. So which will come out to 1,20,000. Now we'll have one doubt, why we are not adjusting inflation on depreciation. This is because depreciation is based on historic cost and not on real term basis. What does that mean? Let's say in this revenue and cost, we are estimating those uh, before the project commences, like now only. As our revenue and costs are projected, those real cash flows has to be adjusted by inflation. But in case of depreciation, since we know the project value at the beginning only, and the useful life is 4 years, so our depreciation is fixed for the next 4 years, which is 2 lakh in our case. And the tax benefit also will be based on the tax rate which is given 60%, and there won't be any change in the tax benefit on depreciation for the 4 years. So it need not be adjusted by inflation. And depreciation is on historic base, as previously told. Inflation will not affect depreciation. So the next part is we'll get the cash flows, net profit after tax. So they've given revenues for the 4 years, then cost, then net profit, then tax adjustment, then net profit after tax. Along with this net profit after tax, we have to add the tax benefit on depreciation. So we'll get a cash inflow. Now this cash inflow is nominal cash inflow, which is inflation adjusted, and we have cost of capital 10%, which is including inflation premium they've given. So that we'll take, and then we'll get the present values. Now after adding up all the 4 years present values, we are getting a value of 9,06,744, and the cost of the project is 8 lakh which they have given. If I reduce the cost, then I'll get 1,06,744, which is a positive NPV. So we can accept this project. Thank you.